I'm not late.
No.
Yes.
Good morning, Chairman. You may begin.
Thank you, Deborah. I appreciate the green light. Morning, everybody. I'd like to call this meeting of the FDIC Board to order. There are several items on the summary agenda. Are there any questions or comments on the summary agenda? If none, may I have a motion to approve the summary agenda?
So moved.
Thank you. And a second? Second. Thank you very much. All in favor, please say aye.
Aye.
Any opposed? The motion is adopted. We have one item on the discussion agenda this morning. It is a memorandum and resolution relating to the regulatory capital rule, amendments applicable to banking organizations subject to Category 1, 2, 3, and 4 standards, and to banking organizations with significant trading activity. Ryan Billingsley, Ben Bosco, Ben Klein, and Ashby Hillsman will present the case.
Good morning, Chairman Gruenberg and members of the FDIC Board. For your consideration today, staff is presenting a proposal that would revise the regulatory capital rule applicable to large banking organizations and to other banking organizations with significant trading activity. The proposal would generally revise the calculation of risk-weighted assets by replacing the current internal models for credit risk and operational risk with standardized approaches, and also replace the current market risk and credit valuation adjustment, or CVA capital requirements, with revised approaches. This new proposed framework for measuring risk-weighted assets, referred to as the expanded risk-based approach, would apply to Category 1, 2, 3, and 4 banking organizations, which includes all banking organizations with $100 billion or more in total assets. Capital requirements would not change for community banks under this proposal. If approved, this proposal would be issued jointly by the FDIC, the Office of the Comptroller of the Currency, and the Board of Governors of the Federal Reserve System, collectively the agencies. I will first provide some background information on the proposal and describe its scope of application and the resulting structural changes to the regulatory capital framework. Following the 2007-2009 financial crisis, the agencies adopted a revised capital rule, which increased the quality and quantity of regulatory capital that banking organizations must maintain. This proposal, presented for your consideration today, would build on these initial reforms by making additional changes to the capital rule informed by experience during and after the crisis. These proposed changes are generally consistent with international capital standards issued by the Basel Committee, commonly known as the Basel III reforms. All banking organizations are subject to generally applicable risk-based capital requirements. Category 1 and 2 banking organizations are currently subject to an additional set of risk-based capital requirements found in Subpart E of the capital rule, which are known as the Advanced Approaches Framework. The proposal would substantially revise Subpart E by replacing the Advanced Approaches Framework with the expanded risk-based approach for calculating risk-weighted assets for credit and operational risks. The proposal would also extend Subpart E's scope by applying it to Category 1, 2, 3, and 4 banking organizations. As a result, large banking organizations would use a simpler and more consistent standardized framework to set capital requirements for credit and operational risk. Currently, banking organizations with significant trading activity are subject to additional capital requirements for market risk, and these are found in Subpart F of the capital rule. Subpart F currently applies to banking organizations whose aggregate trading assets and liabilities equal or exceed $1 billion or represent 10% or more of total assets. The proposal would make substantial revisions to the market risk requirements, incorporate requirements for CVA risk, and also apply market risk and CVA risk capital requirements to all Category 1, 2, 3, or 4 banking organizations. In addition, the proposal would continue to apply market risk requirements to other banking organizations whose trading assets and liabilities equal or exceed 10% of total assets threshold, while raising the trading assets and liabilities dollar threshold from $1 billion to $5 billion. The proposal would retain banking organizations' ability to use internal models for market risk, subject to supervisory approval and enhanced performance requirements, and also adopt new standardized approaches for market risk and CVA risk. The proposal would retain the existing capital rules dual stack risk-based capital structure. Under this proposed structure, a large banking organization would be required to calculate its risk-based capital ratios and maintain regulatory capital under both the expanded risk-based approach, which would be the sum of the proposed credit, operational, market, and CVA capital requirements, and the current generally applicable risk-based rule, and use the lower of the two ratios to satisfy its minimum capital requirements. All applicable capital buffer requirements would apply, regardless of whether the expanded risk-based approach or the existing generally applicable risk-based rule produces the more binding ratio. In addition, consistent with the treatment of banking organizations subject to Category 1, 2, or 3 standards, the proposal would apply the supplementary leverage ratio and the countercyclical capital buffer to banking organizations subject to Category 4 standards. I will now briefly discuss major elements of the measurement of risk-weighted assets under the expanded risk-based approach. For credit risk, the proposal would replace the use of internal models with a new expanded risk-based approach for credit risk. Elements of the expanded risk-based approach for credit risk would apply the same treatment for certain exposure categories as those under the generally applicable risk-based rule. For example, the proposed expanded risk-based approach for credit risk would retain the same risk-based capital treatment for sovereigns, public sector entities, and exposures whose treatment is determined by statute, such as high volatility commercial real estate. However, relative to the current generally applicable risk-based rule, the proposal is more granular, as it includes additional criteria and metrics within exposure categories. Specifically, the proposal would introduce the expanded risk-based approach for exposures to depository institutions, foreign banks and credit unions, subordinated debt, real estate, retail, corporate exposures, and defaulted exposures. The proposal would also modify capital requirements for off-balance sheet exposures through a new exposure methodology for commitments without preset limits, and would modify the credit conversion factors applicable to commitments. For derivatives, the proposal would apply the standardized approach for counterparty credit risk to banking organizations subject to Category 3 and 4 standards. With respect to equity exposures, publicly traded equity exposures would generally be subject to the proposed market risk framework unless there are restrictions on the tradability of such exposures. And as the proposed equity framework would primarily cover illiquid or infrequently traded equity positions, the proposal would eliminate the models-based approach and revise the non-models-based approach to be substantially similar to the equity framework and the generally applicable risk-based rule. Equity exposures to community development investments and small business investment companies would receive a 100% risk weight. For securitizations, the proposal would draw on many features of the existing framework in Subpart E of the Capital Rule. However, the proposal would replace the existing supervisory formula approach in Subpart E with a securitization standardized approach, also known as the SEC-SA. The SEC-SA is a modified version of the standardized approach found in Subpart D of the Capital Rule. However, the SEC-SA includes modifications. For example, a lower risk weight floor for securitization exposures and a higher risk weight floor for resecuritization exposures. Additionally, consistent with the current rule, the proposal would permit banking organizations to recognize certain types of credit risk mitigants, such as guarantees, credit derivatives, and collateral, provided that the credit risk mitigants satisfy certain qualification standards. The proposal would also replace internal models-based methodologies for recognizing the risk-reducing benefits of financial collateral, eligible guarantees, and credit derivatives with standardized approaches. Now, for eligible margin loans and repo-style transactions, banking organizations would be permitted to use a revised collateral haircut approach that increases netting and diversification benefits, subject to modified market price volatility haircuts. For certain eligible margin loans and repo-style transactions with unregulated financial institutions, the proposal would introduce minimum haircut floors that banking organizations must meet in order to recognize any risk mitigation benefits of collateral. For operational risk, under the current capital rule, banking organizations subject to Category 1 or 2 capital standards are required to calculate risk-weighted assets using the Advanced Measurement Approaches, or the AMA, which are based on a banking organization's internal models. The proposal would remove the AMA and introduce a standardized approach for operational risk applicable to all large banking organizations. The operational risk capital requirements under the standardized approach would be equal to a banking organization's business indicator component multiplied by its internal loss multiplier. The business indicator component would provide a measure of the operational risk exposure of the banking organization and be based on inputs compiled from a banking organization's financial statements to capture its lending and investment, fee and commission-based, trading, and other activities. An internal loss multiplier would be based on the ratio of a banking organization's historical operational losses to its business indicator component and would increase the operational risk capital requirement as historical operational losses increase. The proposal would require that the internal loss multiplier be no less than 1. For market risk, the proposal would improve the risk sensitivity and calibration of market risk capital requirements relative to the current rule. Notably, the proposal would replace the value at risk or VAR-based measure of market risk in the capital rule with an expected shortfall-based measure, which better captures the potential losses in market risk covered positions. The proposal would also replace the fixed 10 business day liquidity horizon in the current capital rule with liquidity horizons that vary based on the underlying risk factors to adequately capture the market risk of less liquid positions. Furthermore, the proposal would introduce a standardized methodology for calculating risk-weighted assets for market risk and a new models-based methodology to replace the current framework. The proposal would introduce the concept of a trading desk and restrict application of the proposed internal models approach, or IMA, under the models-based measure for market risk to the trading desk level. Specifically, under the proposal, the standardized measure for market risk would be the default methodology for calculating market risk capital requirements. A banking organization would be required to obtain prior written approval from its primary federal supervisor to use the IMA for each trading desk. If, after receiving approval from the primary federal supervisor to use the IMA, a trading desk fails to satisfy either the proposed desk-level backtesting requirements or the proposed desk-level profit and loss attribution testing requirements, the proposal would require the banking organization to use the standardized approach for market risk for the trading desk. In this way, the proposal would limit application of the internal models approach to only those trading desks for which the internal models are sufficiently accurate for purposes of calculating market risk capital requirements. Irrespective of model approval, the proposal would require all banking organizations, subject to Subpart F of the capital rule, to calculate market risk capital requirements under the standardized measure for market risk. The proposed standardized measure for market risk would consist of 3 main components. First, a sensitivities-based method capital requirement that would capture non-default market risk associated with certain risk factors. 2, a standardized default risk capital requirement that would capture losses on credit and equity positions in the event of issuer default. And 3, a residual risk capital requirement that would address, in a simple, conservative manner, any other known risks that are not already captured by the first 2 components. Consistent with the current capital rule, the proposal would require banking organizations subject to the CVA risk-based requirements to reflect in risk-weighted assets the potential losses resulting from increases of CVA for all over-the-counter derivative contract counterparties, subject to certain exceptions. The proposal would provide 2 approaches for measuring CVA risk. The basic approach, which is similar to the current capital rules simple CVA approach, and a new standardized approach that would allow banking organizations to recognize hedges for the expected exposure component of CVA risk. In addition, for the purposes of calculating regulatory capital, banking organizations subject to Category 3 and 4 standards would be subject to the same regulatory capital treatment of accumulated other comprehensive income, or AOCI, capital deductions, and rules for minority interest as banking organizations subject to Category 1 and 2 standards. This would provide a single approach for the largest firms and ensure that the reported regulatory capital ratios of these banking organizations better reflect their capacity to absorb losses by taking into account unrealized losses or gains on available for sale securities and regulatory capital. Finally, the proposal would also introduce disclosure requirements that would align regulatory reporting requirements with the proposal's other changes. The proposal also would make technical amendments and clarifications to certain provisions in the capital rule. In aggregate, across holding companies subject to Category 1, 2, 3, or 4 standards, staff estimates that the proposal would increase the binding Common Equity Tier 1 capital requirement, including minimums and buffers, by around 16%. Across depository institutions subject to Category 1, 2, 3, or 4 standards, staff estimates that the proposal would increase the binding Common Equity Tier 1 capital requirement by an estimated 9%. To provide banking organizations time to meet the capital requirements under the proposal, and also to develop the necessary reporting and infrastructure requirements, the proposal includes a 3-year transition period beginning July 1st, 2025. The comment period for the proposal would close on November 30th, 2023. Thank you very much, and we are happy to respond to any questions you may have.
Ben, thank you. That was very helpful. I'll now turn to the members of the board. I have a statement and then turn to my colleagues. Today, the FDIC board is considering a notice of proposed rulemaking that would substantially revise and strengthen the capital requirements applicable to banking organizations with total assets of $100 billion or more, including their subsidiary depository institutions, as well as to other banking organizations with significant trading activity. Requirements under the proposal would generally be consistent with international capital standards issued by the Basel Committee on Banking Supervision, commonly known as the Basel III reforms. This proposal is a continuation of the federal banking agency's efforts to revise the regulatory capital framework for our nation's largest, most systemically important financial institutions, which were found to be woefully undercapitalized and overleveraged during the global financial crisis of 2008. Following the 2008 crisis, the FDIC, along with the Office of the Comptroller of the Currency and the Federal Reserve Board, strengthened the banking system through an initial set of revisions to the capital framework. Those revisions raised the quality and quantity of risk-based capital and included the introduction of an enhanced supplementary leverage ratio for our largest, most systemic banking organizations. However, there remain areas of the regulatory capital framework that need improvement. Today's proposal would make important changes that will address capital weaknesses identified in the 2008 financial crisis, enhance the resilience and stability of the banking system, and enable the banking system to better serve the U.S. economy. I'd like to take this opportunity to highlight several aspects of the proposal that I believe would advance this overarching goal. To begin, the proposal would revise the calculation of risk-weighted assets and limit the extent to which banks can use internal models to calculate minimum capital requirements. At its core, the proposal addresses 4 critical areas with respect to risk-weighted assets: credit risk, operational risk, market risk, and financial derivative risk, all sources of risk identified during the 2008 crisis. For credit risk, the proposal would eliminate the use of banking organizations' internal models to set regulatory capital requirements, and in its place, apply a simpler standardized framework. The FDIC has long had concerns about the use of internal models and establishing minimum capital requirements for credit risk because of their lack of transparency and their variability of results. The proposed changes would improve the consistency and transparency of capital requirements and would enhance the ability of supervisors and market participants to make independent assessments of a banking organization's capital adequacy individually and relative to its peers. For operational risk, the proposal would also address the drawbacks of the current models-based approach, which can produce estimates that exhibit substantial uncertainty and volatility, as well as a lack of transparency and comparability. Operational risk generally refers to the risk of loans resulting from inadequate or failed internal processes, people, and systems, or external events, including cybersecurity attacks. As the size and complexity of a financial institution increases, there are more opportunities for operational risk to emerge. The proposal introduces a standardized operational risk framework in lieu of the existing model-based approach, thereby enhancing transparency and comparability. Operational risk exposures have been and continue to be a persistent and growing risk for financial institutions, and the introduction of a simpler standardized calculation for this risk is an important element of this proposal. With respect to market risk, during the global financial crisis, banks incurred significant losses in their trading books. That is, their portfolio of instruments traded over the short term, exposing weaknesses in the existing market risk capital framework. For example, credit markets, in particular those related to structured products like collateralized debt obligations or CDOs, collapsed during the financial crisis. This severely impacted liquidity in these markets. Banks were able to use internal value-at-risk models for these positions, even though the models inadequately captured the risks. As a result, for market risk, the proposal would provide substantial improvements relative to the current framework that are consistent with the goal of enhancing the resiliency of the banking system. The proposal would retain banking organizations' ability to use internal models for measuring market risk, but subject to certain important improvements. In particular, the proposal would replace the value-at-risk measure of market risk with an expected shortfall-based methodology that better accounts for potential losses. The use of internal models would also be subject to enhanced requirements for model approval and ongoing performance testing. These revisions significantly strengthen market risk capital requirements by improving risk capture and requiring banking organizations to demonstrate that their internal models appropriately capture the risk of market risk-covered positions. The proposal also includes a new standardized measure for market risk that's risk-sensitive and provides for comparability across banking organizations. A banking organization may elect to use this standardized method rather than the model-based approach, and in addition, banking organizations that don't receive approval to use the models-based measure would be required to use the new standardized measure for market risk. Finally, risks associated with financial derivatives are addressed in this proposal by the introduction of standardized approaches for so-called credit valuation adjustment, or CVA risk. This CVA risk refers to potential mark-to-market losses on derivatives transactions resulting from the credit risk of the derivatives counterparty. During the 2008 crisis, CVA risk was a major source of losses to bank derivatives portfolios. The revised CVA approaches in this proposal would strengthen the capital framework for CVA risk in a manner consistent with the proposed improvements to the market risk framework. Now, in regard to the scope of application of this proposal, a key consideration with respect to these revisions is the scope. In other words, which banks are subject to the proposed rule. Historical experience has demonstrated the impact individual banking organizations can have on the stability of the U.S. banking system, in particular, large banking organizations. With this in mind, the proposal would apply to banking organizations with total assets of $100 billion or more, and to other banking organizations with significant trading activity. Strengthening capital requirements for large banking organizations better enables them to absorb losses with reduced disruption to financial intermediation in the U.S. economy. Enhanced resilience of the banking sector supports more stable lending through the economic cycle and diminishes the likelihood of financial crises and their associated costs, including obviously potential costs to the Deposit Insurance Fund. The proposal would align the calculation of regulatory capital for banking organizations between $100 and $700 billion in total assets with the calculation already applicable for the very largest banking organizations. As a result, all banking organizations with more than $100 billion in total assets would include unrealized losses on securities categorized as available for sale in the calculation of regulatory capital. As the agencies have learned from recent experience with bank failures, this change would help ensure that the regulatory capital ratios of large banking organizations better reflect their capacity to absorb losses. In addition, the proposal would lower the threshold for application of the supplementary leverage ratio and the countercyclical capital buffer from $250 to $100 billion in total assets. These changes would bring further alignment of capital requirements across large banking organizations, consistent with the proposal's goal of strengthening the resilience of large banking organizations and the banking system. For banking organizations with less than $100 billion in total assets, the revised requirements for market risk would apply if the banking organizations had $5 billion or more in trading assets plus trading liabilities, or trading assets plus trading liabilities equal to or greater than 10% of their total assets. Notably, the proposal would not change the capital requirements applicable to community banks. Now, finally, by addressing weaknesses in the existing regulatory framework, the proposal is expected to increase capital requirements in the aggregate. It is estimated that the proposal would increase Common Equity Tier 1 capital requirements by 16% for holding companies and 9% for insured depository institutions. It is expected that the impact would vary meaningfully by institution, depending on each banking organization's activities and risk profile. The majority of banks that would be subject to the proposed rule currently have enough capital to meet the proposed requirements. Staff of the agencies estimated that 5 large bank holding companies would have shortfalls in their common equity Tier 1 capital requirement under the proposal based on year-end 2021 data. For these large holding companies with shortfalls, the amount is estimated to be below 1 year of average earnings over the last 7 years. In other words, this means these banking organizations would be able to achieve compliance with these revisions through earnings over a short time frame, even while maintaining their dividends. The proposed changes would be phased in over a 3-year transition period. Any final rule, following careful consideration of comments received, is not expected to take effect until July 1 of 2025. Taking the effective date and transition period together, the capital requirements under a final rule would not be fully effective until the second half of 2028. Given the consequence and complexity of this rulemaking, the agencies are providing a 120-day public comment period. So in conclusion, a robust regulatory capital framework is the cornerstone of a resilient banking system. Strong levels of capital available to absorb losses that banks have ensure that banks have the ability to continue to lend to their customers through the business cycle, including during stress. History has proven that insufficient capital can lead to harmful economic results when banks are unable to provide financial services to households and businesses, as occurred during the 2008 financial crisis. This notice of proposed rulemaking on Basel III is an opportunity to make important changes to the regulatory capital framework with the ultimate goal of enhancing the financial resilience and stability of the U.S. banking system, better enabling it to serve the U.S. economy. I strongly support this proposed rule. Finally, I would like to thank the FDIC staff for their diligent and thoughtful work in bringing this proposal to the board today. I would also like to thank the staff at the OCC and the Federal Reserve for all of their hard work as well. That concludes my statement, and turn it over to Vice Chairman Hill.
Thank you, Chairman. I support strong capital requirements and believe that placing limits on leverage is one of the most powerful tools bank regulators possess to promote a resilient banking system. However, I'm going to vote against today's proposal. I have concerns with the impact of excessive gold plating of international standards. I am skeptical of certain aspects of the underlying Basel standard, and I oppose unwinding the tailoring of the capital framework for large banks. Following the 2008 financial crisis, and in response to a general consensus that the banking system was undercapitalized, U.S. regulators agreed to and implemented the Basel III reforms, which significantly increased the quantity and improved the quality of capital banks maintain to absorb losses. As a result, capital across the system grew substantially. The Basel III capital rule was a major piece of a vast post-crisis regulatory agenda, which comprised an extraordinary range of reforms at the largest banks, including standardized liquidity requirements, a long-term debt requirement, counterparty limits, margin requirements, clearing requirements, stress testing, enhanced governance standards, heightened risk management standards, enhanced reporting requirements, trading and activities restrictions, and CECL accounting for loan loss reserves, among many others. In the late 2010s, when banking regulators reevaluated many of the post-crisis reforms, changes to the capital framework were limited and targeted, and regulators generally maintained the robust level of capital in place. At the same time, for a number of years, banking agencies and other stakeholders have regularly and repeatedly commented on the strong capital levels at the largest banks and the resilience of the U.S. banking system. Meanwhile, lurking in the background, U.S. agencies agreed to another round of reforms to international capital standards, now known as Basel III finalization, Basel III endgame, or in some quarters, Basel IV. The goals of these agreements included, among other things, limiting, however modestly, the ability of banks in other jurisdictions to use internal models to lower their capital requirements, and increasing the risk sensitivity of aspects of the standardized approach. Leading up to the final Basel Agreement, international regulators emphasized that the new reforms were not intended to significantly increase capital requirements. In that vein, when the U.S. agencies began efforts to implement the Basel Agreement several years ago, one of the goals was a loose concept referred to as capital neutrality. This goal reflected a general sense that the prevailing post-crisis level of capital in the system did a reasonably good job balancing these sometimes competing objectives of safety and soundness, financial stability, and economic growth, and that large increases or decreases in required capital were generally undesirable. This goal also reflected an awareness that banks in the U.S. have higher levels of capital than those in many other jurisdictions, which is primarily driven by the ability of non-U.S. banks to use internal models to meaningfully reduce the amount of capital needed to meet their requirements. In addition, regulatory buffers in the U.S., including the stress capital buffer, gold-plated G-SIB surcharge, and gold-plated enhanced supplementary leverage ratio, tend to result in more capital than regulatory buffers in other jurisdictions, which include Pillar 2 add-ons and, in some cases, a positive countercyclical capital buffer. Today's proposal rejects the notion of capital neutrality and takes a starkly different path, gold-plating the new Basel standard in a number of ways and dramatically increasing capital requirements for banks with certain business models. To start, large banks in the U.S. would be subject to multiple stacks and stacks within stacks in determining their capital requirements. Large banks would continue to be subject to a standardized approach, but this would be different from what the Basel Agreement calls the standardized approach. Under the proposal, the standardized approach is effectively the risk-based capital rule that applies to most other U.S. banks, but in practice, it is meaningfully more conservative, given first, it includes the new market risk framework, which would apply to less than 10 out of 4,629 banks with less than $100 billion in assets. And second, it includes the full slate of buffers, including the SCB and G-SIB surcharge, which do not apply to any banks below $100 billion in assets. Large banks would also be subject to the so-called expanded risk-based approach, which is the U.S. version of the new Basel standardized approach. Within this stack, a number of items are gold-plated from the Basel standard, including within the credit risk framework, the risk weights for residential mortgages, retail exposures, exposures to banks and credit unions, and exposures to small businesses. Within the operational risk framework, the floor for the internal loss multiplier, and within the market risk framework, the requirement that banks use the standardized approach rather than a modeled approach for default risk charges. The U.S. is also declining to make several modifications that European jurisdictions have proposed, each of which further reinforces the relative conservatism of the U.S. approach. Large banks would be required to determine their capital requirements under each of these stacks and maintain capital in excess of whichever stack produces the most stringent requirement. Taken together, the new framework would subject large banks to, first, a gold-plated, expanded risk-based approach, which is meaningfully more conservative than the single standardized stack implemented in other jurisdictions. And second, an enhanced version of the current U.S. standardized approach, which is both more conservative than the generally applicable standard in the U.S. and not applicable in any other jurisdiction, all while non-U.S. banks are still able to drive down their capital requirements through the use of internal models. Altogether, when also considering, among other things, the impact of the new operational risk charge, which is entirely new and additive to what will often be the binding stack, and the revised market risk charge, which is expected to increase market risk-weighted assets by more than double for the large banks most heavily engaged in capital markets activities, the proposal would have a substantial impact on how banks allocate capital. The result will be some combination of higher prices for consumers, less availability of products and services, migration of U.S. activities out of the regulated banking sector, migration of international activities out of U.S. banks, and more fragile financial markets. As I noted earlier, one of the objectives of the Basel Agreement is to increase risk sensitivity. But risk sensitivity is a double-edged sword with deep pitfalls on each edge. On the one hand, too little risk sensitivity incentivizes risk-taking, as banks can earn higher returns on capital by engaging in higher risk activities. On the other hand, setting increasingly risk-sensitive standardized risk weights always involves choosing winners and losers, promoting homogeneity across the industry, and adding substantial complexity to the capital framework, along with the inevitability of misjudging and mispricing risk. Nonetheless, there are some areas where additional risk sensitivity is justified. For example, in the proposal, incorporating loan-to-value ratios into the risk weight treatment for residential mortgages is understandable. Market participants have been analyzing mortgage credit risk for many decades, spanning numerous business cycles, yielding a great deal of data and experience demonstrating the relationship between LTV and credit risk. By contrast, operational risk is an amorphous concept, a catch-all category that encompasses a large and highly variable set of risks, ranging from fraud to bad behavior to overzealous enforcement agencies to cyber attacks to asteroids. Under the proposal, the standardized operational risk charge would be calculated based on two factors. First, the business indicator component is in effect a proxy for size, but it is a very different proxy for size than that which regulators use for any other purpose, and one that is especially punitive for fee-income businesses. I understand part of the rationale is to capture certain off-balance sheet activities that present operational risk, but there are all sorts of operational risks not reflected on a bank's balance sheet that the proposal does not capture, such as the quality and sophistication of a bank's IT systems, the geographical distribution of its bank branches, or the nature of its personnel, to name just a few. Second, the ILM component would adjust the operational risk charge based on operational losses over the prior 10 years. The proposal states definitively, quote, higher historical operational losses are associated with higher future operational risk exposure, end quote. I suspect the proposal overstates our ability to understand and predict operational risk, and I wonder whether the operational risks for which we care most about capitalizing are those least likely to be captured by the ILM. Overall, I understand the merits of having some consideration for operational risk in the capital framework, but I'm skeptical that a risk-sensitive operational risk charge is actually sensitive to the underlying risk. Next, I'm going to turn to the proposal's treatment of tailoring. In 2018, Congress passed S. 2155, which, among other things, first raised the threshold for which firms were subject to enhanced prudential standards from $50 to $250 billion in assets, while authorizing the Federal Reserve to apply enhanced standards to firms between $100 and $250 billion. And second, mandated that regulators tailor application of enhanced standards for firms in scope. In 2019, the Federal Reserve, in part with the OCC and FDIC, issued the tailoring rules, which implemented both of these mandates by establishing quantitative metrics for the application of standards to large banks. Categories 1, 2, and 3 included all firms with $250 billion or more in assets, plus other institutions that met specific criteria, while Category 4 included the remainder of institutions above $100 billion, who were in effect generally excluded from enhanced standards. Today's proposal repudiates these concepts by aligning the capital rules for all banks with $100 billion or more in assets. This alignment includes application of the supplementary leverage ratio, the countercyclical capital buffer, and the standardized approach for counterparty credit risk, and the treatment of TLAC holdings, mortgage servicing rights, certain deferred tax assets, non-significant investments in the capital of unconsolidated financial institutions, minority interests in subsidiaries of banking organizations, and all other comprehensive income, or AOCI. None of that is at all related to the new Basel Agreement. In addition, the proposal would apply the full scope of the new Basel standard to all institutions above $100 billion. This includes applying the entire market risk framework to regional banks with de minimis trading activities who have never previously calculated market risk capital and who will now need to build out market risk compliance operations and systems, despite market risk having virtually no impact on the institution's actual capital levels. For purpose of the capital rules, the proposal effectively collapses categories 2, 3, and 4 into one category. The proposal undoes almost all of the tailoring of the capital framework for large banks and is a repudiation of the intent and spirit of S 2155. It is further a troubling sign for future policymaking, a signal that regulators intend to treat all large banks alike in defiance of congressional directives and in contradiction to the objective of a diverse banking sector with banks of varying sizes, niches, and business models. Of course, I recognize that 3 Category 4 banks failed earlier this year at a substantial cost to the Deposit Insurance Fund, and in one case, in quite spectacular fashion. I think there are lessons for us to consider from these failures around topics like interest rate risk, deposit insurance, contingency funding, and large bank resolution. But I also think it's important that our reactions be thoughtful and targeted, and that we avoid the temptation to overregulate all Category 4 banks in response to the unique circumstances of the spring failures. It's worth noting that implementation of the new Basel Agreement was expected to result in no increase in required capital at any of the 3 banks that failed, but would result in major increases at several other Category 4 banks. Finally, the proposal would require large banks to incorporate unrealized losses and gains on available for sale securities in their capital requirements. This is a complicated topic, and I do not object to seeking comment on it. However, we should appreciate that while the proposed change may have reduced the likelihood of the specific catalyst that triggered the run on Silicon Valley Bank, it would have done little to address the underlying fundamental issue. Of SVB's bond losses, 85% were on its held-to-maturity portfolio and thus unaffected by the proposal, a percentage that may have been higher had the bank's capital requirements incentivized such a shift. And unrealized losses on securities were not a major driver at Signature or First Republic. The fact that this change is only proposed for firms with $100 billion or more in assets and only for AFS securities, I think reflects the challenges with using capital rules to address these issues. I plan to vote against the proposal. I would like to recognize and extend my appreciation to the staff for all their hard work going back many years. I understand this can be a grueling process. I want to thank you all for all the long hours you put in.
Thank you very much. Director McKiernan?
Thank you, Chairman. I'll also be voting against this proposal. I've submitted a very detailed, maybe overly detailed statement for the record. So I'll just hit maybe 2 or 3 key reasons for my dissent here. First, in my view, this proposal asks us to put a lot of faith in the Basel framework, and I just can't make that leap of faith to put in kind of that degree of confidence in this international framework. Second, in my view, this proposal is a product of really a singular focus on increasing capital, really without regard to the associated economic cost and without regard to maintaining consistency with the longstanding principles that have rationalized the calibration of those capital requirements. So before getting into all that, let me thank the staff for all the work you've put into this proposal, the responsiveness, and helped me get briefed up on a very technical proposal. Really appreciate all that. And I also want to say, I want to acknowledge this proposal was clearly a very challenging undertaking. I know a lot of work went into this. I think in part, this proposal was particularly challenging because, well, the Basel III standards that this proposal seeks to implement are candidly something of a mixed bag. Maybe that's a bit of an understatement. There were so many compromises made behind the scenes at Basel on the way to developing these standards that at the end of the day, it's really hard to make sense of key aspects of the standards. And make matters worse, Basel apparently doesn't feel it necessary to give really any reason or explanation for some very considerable significant changes and evolution in those standards between the last consultative document and the final standards. So the Basel standards, quite challenging as a starting point for this proposal. I think that's particularly true for market risk and operational risk frameworks. Take, for instance, the operational risk approach. The first Basel consultative on this said right up front, this business indicator approach is really developed with universal banks in mind. And it also says in that first consultative this approach, this business indicator approach, won't work for high-fee banks. Second consultative document reiterates this is a problem, that the approach doesn't work for high-fee banks, helpfully proposes a fix. Bizarrely, without any explanation, behind the scenes, Basel Committee drops the fix, gives us no reason for why it's ending up where it's ending up. So that leaves then this proposal trying to defend an approach to operational risk capital that we know doesn't work well for all banks, and yet with no real explanation, no reasons to kind of defend ourselves, right? My written statement goes into other examples of call them dubious design decisions made at the Basel Committee without really any explanation. But ultimately, at the end of the day, this proposal asks us to put a lot of faith in Basel. I just don't see the grounds for the faith, and really quite the contrary. Second reason I'm dissenting is despite the questionable starting point that the Basel framework offers us, about the only time this proposal finds cause to deviate from the Basel standards is to push capital yet higher and higher. This push towards higher capital really pays very little regard to the associated economic cost. Take, for instance, our approach to mortgage. Across two administrations, the U.S. regulators worked through the Basel process to develop a modernized set of capital requirements for mortgage that were aligned with the latest and greatest evidence on what the actual risk was on these exposures. Where Basel ended up ultimately is generally consistent with what the U.S. proposed at the Basel negotiation, the Basel discussion. So maybe here we actually have some cause for optimism about where Basel ended up. Another point of validation, perhaps, where Basel ended up is roughly aligned with the capital requirements the Federal Housing Finance Agency imposes for similar mortgages held at the GSEs. So maybe that's another validation point. But because the Basel approach would reduce capital, this proposal's reversed course and adds a big surcharge to the Basel capital requirements for mortgages. Proposal offers no loss history or evidence in support of the surcharge. The proposal doesn't even acknowledge that we're implicitly rejecting a recommendation made by FSOC that we, the banking agencies, and FHFA work to harmonize capital requirements across the banks and the GSEs, so to reduce the risk, the kind of market or the regulatory incentives that concentrate mortgage credit risk at the GSEs. We just add a big surcharge and move on. And of course, there will be real economic cost to this. Low and moderate income borrowers who can't always afford a 20% down payment will see a big increase in capital. That could result in higher mortgage rates for these borrowers. We're also going to perpetuate a capital arbitrage that drives mortgage lending out of the banking system and concentrates it in the $7 trillion GSEs. That increases risk to financial stability. All of this in the name of higher capital, regardless of the cost. Maybe stepping back, I think there's a more fundamental issue here. This proposal clearly starts from the premise that we need more capital in the system. It then works backwards to achieve that. I'd maybe suggest a different approach. In my view, we should be explicit about how we are calibrating each component of the regulatory capital framework, and then we should let the evidence in that calibration framework kind of take us where it takes us. Maybe that means higher capital. Maybe it means lower capital. Maybe it means higher capital for some activities and lower capital for other activities. But the point here is we need to avoid the temptation to work backwards, whether towards higher capital, towards lower capital, towards capital neutrality. We need to take a bottom-up approach instead of a top-down approach. To close, strong capital is critical to safety and soundness. Strong capital is critical to financial stability. Strong capital is critical to ending bailouts. So I really hope to be able to support this effort to enhance our capital framework. But I can't support something just because Basel told us to, especially if it won't give us reasons. And I can't support something that reverse engineers higher capital without regard to the cost. Thank you, Mr. Chairman.
Thank you very much. Director Sue?
Thank you, Mr. Chairman. I support the notice of proposed rulemaking to revise the capital requirements applicable to large banking organizations and banking organizations with significant trading activity. Bank capital requirements are like building codes. They're foundational and they establish rules so that the public can rest assured that banks, like buildings, are safe and resilient to stress. Large banks are like large structures, skyscrapers, airport terminals, concert halls. The rules governing their foundations need to take into account their size and complexity and the stresses they may encounter. Recent events demonstrated the effects that stress at a few large regional banking organizations could have on the stability, public confidence, and trust in the banking system. While the recent events may be attributed to a variety of factors, the effect on financial stability supports further alignment of the regulatory capital framework across all large banking organizations with $100 billion or more of assets. Just as the public expects building code to be robust and not to cut things close, especially for large structures, the bank capital requirements need to be robust and not penny-wise, pound-foolish, especially for large banks. Strong capital requirements allow banking organizations to serve as a source of strength for the U.S. economy during times of economic stress and to continue to lend to creditworthy households and businesses through a variety of economic cycles. The proposal will strengthen the regulatory capital framework by improving its comprehensiveness and risk sensitivity, enhance the financial resilience of these banking organizations, and improve transparency, facilitating more effective supervisory and market assessments of capital adequacy. The proposal is generally consistent with the international capital standards issued by the Basel Committee. Consistency will help ensure a level playing field internationally, which will promote the competitive equity of U.S. banking organizations with their foreign peers. Where appropriate, the proposal differs from the Basel standards to reflect specific characteristics of U.S. markets, practices of U.S. banking organizations, U.S. legal requirements, and policy objectives. Finally, the proposal will be open for comment for 120 days. We will carefully review and consider all letters. I encourage commenters to include assumptions about capital distributions and competition from banks and other financial institutions in their analyses of the impacts of the proposal on lending and economic growth. Today's banking system has more large and complex banks than ever to support our dynamic economy, while uncertainties and the risk landscape continue to evolve. Our capital requirements need to be calibrated to this reality, providing strong foundations for large banks to be resilient to a wide range of stresses today and into the future. I support the issuance of the NPR and encourage all stakeholders to submit comments on the proposal. I especially want to thank staff who have been working on this for quite some time. And this is one of the most technical areas, and I'm very proud of staff at all the agencies working together to put this proposal together. Thanks.
Thank you. Director Chopra?
Well, first, let me just say without any irony or sarcasm that for those who are interested in bank regulation, this is a riveting meeting. And it's really good to hear all the details and every points of view on it. And I think that I want to just, if I could ask your indulgence, there's a few points that have come up that I just might ask the staff to comment on before I share my own statement. So a couple questions, and be as brief as you can, but I hope you can explain it given this is a public meeting. One of the changes proposed in the package would eliminate banks' ability to use in-house models. You've heard this referenced a few times to determine their capital requirements for lending activities. I wonder if you could talk about the agency's experience in supervision with these internal models in the past and the justification for making a shift in the proposal.
Sure. Yep. Happy to answer that question. Thank you. So it is the agency's experience that the use of models to set credit risk and operational risk capital requirements have produced variability across banks in the estimation of exposures with very similar risks. So it's this variability combined with the complexity of these models-based approaches that can reduce confidence in and lessen the transparency of the risk-based capital ratios. So by replacing internal models with standardized approaches for credit and operational risk, together with robust public disclosure, the proposal would enhance the transparency of capital requirements and at the same time simplify the framework.
Yeah, I think any examiner who's had to look at internal models, even just looking sometimes at a pretty basic pivot table, can take a long time. And when it comes to very complex models, it's very difficult to ascertain whether it is producing the right type of outcome. Let me shift to value at risk. The proposal would replace a key methodology for determining market risk for trading activities referred to as value at risk or VAR. I wonder if you could share a little bit more some of the weaknesses in that methodology and how the new approach, which we refer to in the proposal as expected shortfall, would address these deficiencies.
Sure. So a weakness of the VAR-based measure is that it does not do a great job capturing extreme losses in a bank's trading portfolio. And that's because VAR ignores the potential losses beyond a set threshold or a confidence interval. In contrast, expected shortfall, it does take into account the potential losses beyond the set thresholds to better capitalize for the potential losses in a trading portfolio.
And I think this relates to what the acting controller said. You're thinking about resilience and shocks, and sometimes that can be not easy to just bound within a specific interval. Operational risk is a bit different conceptually than credit and market at risk. I wonder if you could just say a little bit more about the importance of capturing the totality of a bank's business activities and for purposes of operational risk, and walk through how the business indicator framework accomplishes that goal.
Yeah, thank you for that. So experience has shown that operational risk is inherent in all business activities in a bank. The proposed operational risk requirement includes a business indicator framework, and that includes 3 components, each of which would serve as a broad measure of the activities in which a banking organization typically engages. And without getting into too much detail, there's 3 components are the interest, lease, and dividend component. There's a services component, which captures fee-based activity, and also a financial component, which tends to capture trading activities. So in total, the business indicator framework aims to capture the volume of a banking organization's activities and thus serves as a proxy for operational risk.
Good. And I want to highlight also something the chairman mentioned. In the proposal, the banking agencies would provide essentially 4 years, roughly until mid-2028, for firms to fully come into compliance based on big banks' profitability and, importantly, their dividend and buyback levels. How does staff project the reasonableness for banks to meet the new rules by retaining earnings?
So as we discuss, as the proposal discusses in the preamble, the changes to the risk-weighted asset calculations may result in a shortfall for some large bank holding companies with over $100 billion in total assets. But what we've seen is that the largest U.S. bank holding companies annually have earned an average of 180 basis points of capital ratio from the time period between 2015 and 2022. So based on this earnings experience over the last several years by these organizations, and also consistent with the statement made by the chairman earlier, it does appear that these organizations would be able to come into compliance over the transition period through their retained earnings, even while maintaining their dividends. The preamble does recognize, though, that there is an impact of the proposal on Category 3 and 4 banking organizations due to the inclusion of unrealized losses in available for sale securities in regulatory capital. But given that unrealized gains or losses on available for sale securities can fluctuate over time, the preamble discusses the impact from a long-run perspective. And as you've pointed out, the rule does include a 3-year transition period to support the ability of banking organizations to meet the revised requirement.
Good. I'll comment separately that, English is a very rich language, often with words that have many synonyms, many adjectives. One quirk of English is that we use the word capital in lots of different ways. Capital city, capital letter, capital punishment, equity capital. And I think sometimes that word doesn't totally get used in clear ways. And I understand no bank wants to hold more capital, but sometimes you hear bank executives describe capital as if it is cash in some sort of vault that doesn't really have any use other than sitting there, and it can't actually be used for any kind of activity or lending. And I guess I'm just going to ask, I think we all have our own views on that assessment. Is that an accurate description? And I wonder, from the staff's view, could you clarify what counts as capital And if it's indeed in some sort of vault?
Right. So equity capital, so it's not locked away in a manner that it prohibits or inhibits its use to support the real economy. It's deployed in numerous ways that benefit the bank, stakeholders, and the economy. So for example, capital funds a bank's operations. It's allocated to make loans to local communities. And it also can be distributed to shareholders in the form of capital distributions when appropriate, when the bank has sound financial performance. And equity capital is also important because what it does is it helps to ensure that banks have the ability to absorb losses and unforeseen shocks while at the same time continuing to support their customers.
Okay, well, here's where I come out on this. Our financial system is critical infrastructure for our country, like telecommunications, transportation, and energy infrastructure. Finance and banking power the economy. And the financial system must work at all times. Just as power outages, highway closures, and cellular tower failures can be highly disruptive to everyday life, financial crises can paralyze the economy in ways that are difficult to repair. The costs of systemically important bank failures, especially too big to fail Wall Street banks, are extraordinary, with the pain disproportionately felt by those who bear no responsibility for the crash. Businesses can't finance their operations and workers lose their jobs. People can't finance a car, a new home, or everyday expenses. The economy can rapidly contract, and it takes a long time to turn the lights back on fully. And some of the social and economic scars often never heal. Sometimes increasing the resilience of critical infrastructure is quite hard. To make our telecommunications infrastructure less prone to cyber attacks, we leverage the latest computer science methods and emerging technologies. To make our transportation networks less vulnerable to natural disasters, we deploy cutting-edge engineering techniques. But to be honest, when it comes to increasing the resilience of our financial system, it's easier. The owners of these large financial firms need to put more of their own money at risk rather than relying so heavily on other people's money. This makes them less likely to fail and reduces the risk of contagion throughout the financial system. In March, we saw the failure of systemically important banks. Most people had never heard of them, and those banks were a mere fraction of the size of the very largest Wall Street banks. Nevertheless, this board and the Federal Reserve Board of Governors unanimously recommended to the Secretary of the Treasury that we needed to step in to protect uninsured depositors, or there could be a potential meltdown. If shareholders, rather than the public or taxpayers, shoulder more risk, we'll reduce the likelihood of much larger catastrophes. Because big bank failures impose such massive pain on the economy, and banks themselves prefer to rely on other people's money to fund their operations, we are proposing a rule that requires their shareholders to have some more skin in the game. The rule utilizes a principle referred to as risk weighting. The requirements are tailored to the estimated riskiness of the bank's loan and investments. And I'm generally skeptical of risk weighting since it can sometimes be very complex, create difficulties in enforcement, and lead to market distortions. Bright line rules and simple formulas, including a measure called the leverage ratio, are easier to follow and enforce. However, the proposed rule is drawn from international standards that seek to make the global financial system more resilient, increase cross-border consistency, and limit regulatory gamesmanship. The proposed rules seek to close loopholes previously exploited by banks to evade their obligations. For example, the proposal will close the loophole that enabled Silicon Valley Bank and others to ignore certain unrealized losses on their bond portfolios as interest rates creeped up. It would also ban banks from relying on in-house models to determine risk of lending activities, which has been a roadmap for abuse, and would add more rigor to the formulas used to judge the riskiness of trading and derivatives activities. To ensure a smooth transition to the new requirements, owners of these banks would effectively be given 4 years to increase their skin in the game to the new required levels. Over the past 4 years, Big banks paid out more than $500 billion in dividends and share buybacks to their owners. This is just a fraction of what they'll need to take on that is currently shouldered by taxpayers and the public. Increased resilience requirements will generate a wide range of economic benefits. They support long-term economic growth, given fewer interruptions in the availability of credit and financial services. Banks that fund their operations with more of their own money lend more to businesses and households, particularly in times of stress. Many studies conclude that the economy would benefit greatly from an even more significant increase in capital requirements than are being proposed today. Struggling banks will limit their lending. Failed banks don't lend at all. And we've never endured an economic calamity that harms our people because our largest banks were too stable. The requirements also reduce some of the competitive disadvantages faced by smaller local banks. Shareholders of local banks typically bear more risk than investors in the biggest ones, and that's partially because the market believes the government will step in with a bailout when big banks fail. These requirements help level the playing field. Of course, regulators understand that no banks want to face higher capital requirements, particularly for top executives of the largest banks. Higher capital makes it a bit more difficult to generate bigger bonuses and send more cash out the door to shareholders. But right now, those bonuses and shareholder payouts are essentially indirectly subsidized by the public, and this shouldn't continue. We should welcome, and we are welcoming, comments on these proposed requirements. I'm especially interested in ways to simplify the methodologies used to calculate some aspects of it. And our effort, of course, must be complemented by further actions to increase resilience in the non-bank financial sector, where many other risks to the financial system are lurking in the shadows. There is many efforts to address that, and we must do that as well. Thank you, Mr. Chairman.
Thank you very much. And any other questions or comments from the board? If I may, let me thank all of our board members for their thoughtful comments today, which really suggest a serious engagement with an important set of issues. With that, may I have a motion with respect to the proposed amendments to the regulatory capital rule?
So moved.
Thank you. And a second? Second. Thank you. I'll now call the roll for the vote. I vote aye. Vice Chairman Hill?
No.
Director McKiernan?
No.
Director Sue?
Aye.
Director Chopra?
Aye.
The motion is adopted, and that concludes the discussion agenda for today's meeting. Let me once again thank staff for their very thoughtful and helpful work
Thank you.
on this issue. If there's no new business, I'll adjourn this open session and we'll move into closed session. Thank you all very much.